Hello everyone, today is May 27th and this is the third class of the May special trading Elliott waves and Wyckoff methods combined together. And today is going to be a very interesting session because if the first session was uh, devoted to Elliott wave analysis and the second session was devoted to Wyckoff method case studies, today we're going to attempt to have conversations and discussion with Jeffrey about the synergy of these two methods and how we could use them together. And this was a very frequent request with your emails to us, so we appreciate your feedback. We'll talk about different schematics. We'll talk about the current market and how we, from our two perspectives, would interpret what's going on right now in the marketplace. And then any type of questions that you might guys have at this point. I think the last 30 minutes or so we could devote to your questions. Jeff, how are you doing today?
I'm doing awesome.
All right. Happy Thursday.
Back at you.
Okay. Well, Jeff, what to me, the whole idea about synergy of Elliott wave principles and Wyckoff methodology was brought by Dr. Henry Pruden. Hank Pruden was a teacher, and it's so hard to even say this, was a teacher. But he passed away in 2017, so just recently. And he was a teacher, he was my mentor. I've done so much work with him at Golden Gate University, at TSA local technical analysis organization, where Jeffrey was invited multiple times to present. Also with E03 and the CMT. So, he was a big kind of like prominent figure in technical analysis. And he has created the class. It was an extra class, I already forgot, like a selective class, yeah, where he was talking about the combination of both Wyckoff method and Elliott wave principle. And together with him, we've created this schematic, which is this black and white copy here in the middle of the page. And when we started working with Jeff in 2018 on the first installment of the specials on Elliott and Wyckoff, we used it, but we kind of want to come back here. That's number one. Secondly, we want to discuss maybe characteristics of different spots. And this is not the most accurate version for a couple of reasons. Well, first of all, very blurry because I created this version back in 1998. So the computers, was using the paintbrush or something like that. And then secondly, there are multiple corrections that Jeffrey has here for us in terms of how it should be with the Elliott wave count. So let me first talk about what the schematic is about, at least in Wyckoff terms, and then we'll turn to Jeffrey and we'll try to talk about that synergy between these two methods. So you are looking at the price cycle where you have an area of accumulation, and then you have continuation patterns, and you have an area of the distribution, and then continuation patterns to the downside. The first big pattern is the accumulation, where you have the stopping action from the downtrend, you have a change of behavior in the automatic rally, a test of the supply, a secondary test, and then multiple other tests around the boundaries of the trading range that was created by the change of behavior, attempt to commit to the downside and failure, recovery, sign of strength rally, backing up action, which is quite complex with a sign of strength in the middle, then another reaccumulation range, and final buy and climax climactic run. Change of behavior, test of the buy and climax, test, minor sign of weaknesses, showing that there is more selling now than not. Uh, Second point of excitement into the upthrust action, sign of weakness, last point of supply, break, and then we go down. So that's how, in a very you know minor details, we're going through this schematic. Hank also was talking about the sentiment, and he was talking about the contrarian opinion. So during the accumulation phase, we're going to have a lot of fear, and then that sentiment is going to change as the uptrend develops. And when we come into the distributional range, we have a lot of characteristics of greed. And then the volume signature here is going to be as such that at the stopping action, we're going to have a lot of volume spikes. Then absorption will bring us to a decreasing volume signature. Spring or last point of support or shakeout will provide us with local liquidity that will absorb the final shares and will push the price up in a much different way, which also will coincide with the increase in the volume, showing the increase in the demand. And then throughout the uptrend, we're going to see elements of where demand is increasing and overwhelming supply. At the point of the distribution, supply is going to come as a hidden supply into the excitement by weak hands, and then the same is going to repeat on the upthrust action. And then from there, it's basically supply, demand is very weak, and then capitulation into the stopping action again. And that's basically it. But there is definitely a different layer to this. So as you could see, for instance, I mentioned selling climax, automatic rally, secondary test, spring, last point of support, sign of strength, backup action. Those are Wyckoff semantics. And there is definitely a different layer here, which is, the Elliott wave principle. So with that, Jeff, I don't know. I think we should start here because this would be a much more correct representation. And I apologize again that I didn't do this.
No worries on that. And I think you bring up a very strong point whenever you're using the word semantics. I think the Elliott wave model, behavioral model, which is nothing more than the wave patterns and those 5 core structures that we talked about 2 or 3 weeks ago, it lays over perfectly with everything that a Wyckoffian would use. So in many, many ways, Roman, in my opinion, whenever you're a Wyckoffian, you're pretty much looking at the market the same way an Elliottician does, but you're looking at kind of different things, and you're looking, you're simply using different language. That's the thing that continues to kind of like excite me, is that again your spring phase or your accumulation phase, and then your mark up phase, and then your distribution phase, and then your mark down phase. Well, your markup phase is nothing more than an Elliott wave impulsive rally, a 5-wave move. And then as you see your distribution phase, that would incorporate, say, a 3-wave decline in wave 4, and then as you have sketched out on the slide here, perhaps an ending diagonal where you make a moderate new extreme beyond the wave 3 origin point. And then at that point, that would actually culminate the larger trend, and then you go through the markdown phase. So again, we're looking at the market kind of the same way, but the language is just simply a little bit different. That's it.
Yeah, yeah, I absolutely agree. Yeah, and it kind of goes to my maybe personal axiom about technical analysis in general, and so many variations on the way how people look at the price structure or behavior of the price and volume. It's that the ultimate truth of the chart could be described in different ways, but it will talk about the same thing. Whether it's the third wave or a sign of strength, it still should be characteristically described the same truthful market action. So, and it's just so beautiful when those kind of like two models coincide. So please walk us through here through your Elliott wave.
Okay. Well, let me see. Roman, I don't seem to have the cursor, so if
Oh, I'm
I'll just
sorry.
kind of follow along
Yes.
with you,
Hold
if
on
you
a
want
second.
to. Okay.
Let me. Yes. So now you should have this
Okay. There we
drawing
go.
capacity. Yeah.
Okay, I'll use the highlighter. Okay, so beginning from the left-hand side of the screen, what you would see from, say, an Elliott wave perspective, your initial decline, that would be a 5-wave move, and then you have your 3-wave counter trend move. Well, we'll just, in this instance here, call that a flat correction, because if you look closely at Roman's diagram, you see a 3-wave move up, 3-wave decline, and then maybe a 5-wave move, or maybe we simply call that a WXY, but notice how far prices travel during this phase and the amount of time. Okay, that's a key thing with whenever we're looking at impulsive structure or corrective structure as an Elliottician. Your impulse waves, your waves 1, your wave 3, wave 5, that's when prices are going to move the farthest in the shortest amount of time. It's a key characteristic of impulse wave development. Now, a counter trend move, a correction, either a zigzag, a flat, or a triangle, those are going to be very time consuming, very choppy, and very sloppy. So you can clearly see prices fall very far in a very short period of time. And then during this extended period of time, we basically make a 50% retracement. And then we see this move down, again, 5-wave move. So we could look at this as maybe 1, 2, 3. This consolidation, as defined by the trend lines, looks like to be a contracting triangle 4th wave. A contracting triangle is very important to an Elliottician, primarily because it is one of the 3 types of primary corrective structures, the other 2 being a zigzag and a flat. But a triangle has very significant meaning. It means that the next move is going to be the final move of the larger sequence, which is why a triangle always occurs in the wave prior to the final wave of a sequence. This is why we find triangles in, say, wave 4 of an impulse wave, or wave B of a zigzag, or an X wave, perhaps, if you're working a complex correction. So the formation of a triangle is very significant, and it has a lot of meaning for an Elliottician. And that tells us we have one more move coming, which we call a triangle thrust. And not only will this triangle thrust be essentially the result of the triangle, but it will finish the larger move. So in this case here, because this is a 5-wave decline, we can actually say maybe that's a wave C of 4, or maybe this is wave C of 2, because the wave principle is very fractal in nature, meaning that these patterns that we work with, those 5 core structures, they build larger and smaller versions of themselves. And I know Wyckoff is very much the same way, because you've seen Roman trade, what was it, Tesla or Bitcoin, on very, very short-term intraday price charts, but he's also introduced very long-term daily and weekly price charts. The same is, again, true for the wave principle. I do 5-minute, 60-minute analysis of either soybeans or the E-mini S&P, but I'm also looking at what's going on the weekly and monthly chart levels in these markets as well. So we have this 5-wave decline. It's going to be wave C. And then from there, once we finish our spring, that's when we see our 5-wave move up. And that's going to be wave 1 of an impulse wave. Now, again, one of the things that I think is interesting and possibly useful for the Wyckoff-ian would be when you're coming down doing this, say, the mark down into the accumulation phase, notice your counter trend moves. Basically what you're working with, either short-term or longer term, these are 3-wave moves. So when you see strength, that strength definitely begins to develop correctively. But when you see a change of seasons, go from spring to summer to winter to fall, when you see that change of seasons, when you change from accumulation to markup, something very subtly begins to occur on the price chart. Notice now your 3-wave declines, your counter trend moves, they're now a 3-wave move down. So instead of over here to the left, being a three-wave advance, now your moves are three-wave declines. This tells us that the larger trend is beginning to turn up. You're in that markup phase. So you have waves 1, 2, and again, here's the fractal of wave 3, where you've got wave 1 of 3, 2 of 3, up in wave 3 of 3. Here's your triangle, wave 4 of 3, wave 5 of 3, and then you pull back. And then, of course, you must adhere to the rules and guidelines of the wave principle. For example, the guideline of the right look, sometimes what I refer to as the guideline of proportionality. And then you form another pattern here. And this is the second type of motive wave structure that there is. And we discussed this in the first class. This would be an ending diagonal. Okay, well, an ending diagonal leads to a very swift, sharp, volatile move back to below the origin of the pattern. Okay, so here we have the result move down. That could be wave 1, that could be wave A. But again, now notice what's occurring. Your advances, your strength, it's forming in three-wave fashion, just as it did over here. Now, the number of waves, whether this is a three-wave decline or whether this is a five-wave move, and again, that's what another aspect of the wave principle that's important not to miss or look over. It's the direction of the five-wave move which tells you what the larger trend is. So if you see five-wave rallies or five-wave advances, impulsive rallies, that tells you the trend is up. Now, in this case here, during your markdown phase, Roman has sketched out a five-wave decline. Okay, this tells me that the larger trend is now turning down, and this is most likely wave A of a larger corrective structure, or possibly wave 1 if we have indeed achieved a very significant trend change of say, greater magnitude. Does that make sense?
Yeah.
Okay, good.
Okay. Yeah, no, that was brilliant. Yeah, that was so good. One of the things, Jeff, that as I listen to you throughout these three sessions, one thing for me as a Wyckofian just comes back and comes back and comes back. It's the character of the swing, whether it has like 1, 2, 3 ABC structure or 1, 2, 3, 4, 5 structure. So it's just this change in character signifies change in bias. So that's what's kind of like landing for me really well.
Okay, good. Yeah, the direction of the impulse wave is basically kind of because a lot of times you can think of the wave principle, and I'm sure there's Wyckofians who view the framework of Wyckoff as the seasons. You spring, summer, winter, fall, your accumulation phase, your markup phase, your distribution phase, and then your markdown phase. Well, Elliotticians, we kind of rely on the wave structure to point the direction, and it's primarily the direction of the impulse wave. Five-wave rallies basically tell us that what's the best way to, words? Well, think of the ocean, okay? You've got waves, you've got ripples, and then you've got, the current, the Gulf Stream, or the tide. So you do have this natural ebb and flow found in nature, and I continue to see this natural ebb and flow of like the phoenix, the decay and growth cycle. That's why Elliotticians focus so much on Fibonacci and Fibonacci ratios when we're measuring the extent of either a decline. We use Fibonacci retracements, or the growth of a move, how far a wave will actually travel. Then we use Fibonacci multiples. But this whole idea of essentially financial markets reflecting life itself or nature, again, whether you're looking at it seasonally, winter, spring, summer, fall, or simply looking at the movement of the ocean, the tides, the waves, the ripple, the current, very much the same thing. And when you're in rhythm with the market as an analyst, and especially as a trader, it's so exciting. It's kind of like the light bulb goes off for so many people for the very first time once they begin to grasp these larger, say, esoteric aspects, which are the underpinnings, I think, of technical analysis.
Wow, so well said, Jeff. I usually tell my students we can't escape the gravity of the universe because everything what happens with us is kind of like whatever happens with that big thing that we call universe. Unbelievable. So many things that repeat themselves in the same way.
Mm-hmm. Mm-hmm.
Well, okay. How about this? Let me kind of probe you with some of the questions here on this schematic, and then I took some of the slides from your presentation. So, for instance, this slide right
Oh,
here.
perfect.
Yeah, and what I wanted to start our next discussion with is kind of an understanding of how what are the common structural elements for the beginning of the uptrend and then for the end of the uptrend. Um, could you maybe give us some variations on what your expectation would be into those final, let's say, stages of the uptrend or into the final stages of the downtrend?
Okay, well, I think the wave structure that you have here, Roman, it's significant because essentially what you have over here to the left, again, this is a triangle. A triangle, as I said earlier, it's a very significant wave because it says you have one more move coming and then the party's over. Okay, so the positioning of this triangle is perfect because it says, okay, hey, we've got one more move down, and then following this decline, this move is going to be a very significant move because the triangle is going to finish the larger move down.
Okay, well,
Okay.
Jeff, let me ask you this question.
Okay.
When do you think this specific structure might occur, before the final move, and why does it take this particular shape?
Well, I think a lot of times, as far as the triangle goes, it's indecision. Okay, at this stage of the game, it's indecision. People have weathered this decline here, so people are kind of thinking, okay, hey, is the bottom in place, or is the bottom in place, or is the bottom in place, and they keep hoping because as a trader, because I wear I'm always reminding myself. I think I look at the markets, number one, from an analytical perspective, but I also have to look at the markets from a trading perspective. So from a trading perspective, as a trader, I always got to make sure, my fear mechanism is in check, my greed mechanism is in check, my ego mechanism is in check, and also my sense of self-worth or self-doubt is also in check. Okay. But one thing that we've talked about, I think, in the last session, and whenever we were looking at one of your, I think that one trade that you were kind of beating yourself up about, and I just said, hey, that's kind of like the cost of doing business. And I showed you one of the examples that experiences I had with Carrera, ticker symbol CARA, where, hey, it's going to happen. Life just happens. But I sometimes refer to that as Jeffrey's Law. Whatever adversely affects the most people tends to be what happens. So you really do have, and I guess I'll use your word, capitulation going on down here at the bottom. You've got a bunch of people who are still have suffered through the bloodbath and they're hanging on. And the only reason they're hanging on right now is hope. Okay? Anytime, and this is worth writing down to anybody who's listening, anytime hope that becomes part of a trading equation, it's usually a red flag that, hey, you need to step back and stop. Okay, it's a danger zone. So people at this point, they've suffered through the traders, suffered through the bloodbath. They're looking for a bottom desperately because they're underwater. They're hoping it's there. They hope it's here. They hope it's here. And finally, what happens? Well, whatever adversely affects the most people tends to be what happens. So everybody who was hoping for the market to go long finally just gets exacerbated, and they say, fine, I can't take any more pain, cut me loose. Or the people who are bottom picking, the maybe say retail traders or your aggressive type traders, they're buying here, or they're buying here, they're buying here, and their stops are at all these lows. So what happens? The market comes down, clears out all those stops. So basically, everybody who weathered the decline, they're totally disgusted at this point, and they're just like, I never want to look at this market ever again. Or the people who are, were long trying to bottom pick, they just got cleaned out. So now you've got all these available shares that nobody wants. And then that's when, the smart money really comes into play. And it's just like, man, what? Coke trading for $40 a share? It's a $180 stock. Let's start buying. And they're buying and they're buying and they're buying and they're buying because they have that longer term view.
Yeah.
Does that make sense?
Yeah, absolutely. Yeah. And, it's kind of like we are definitely describing the same events. The wave three, as I remember, as I recall from my studies on Elliott wave, is could be the largest wave, could be the most aggressive wave. And this is where, in Wyckoff terms, we're seeing that capitulation, which is expanding downward spread, increasing volume signature, gaps down, and just very kind of like catastrophic capitulation into a significant low that starts accumulation formation. Okay, well, Jeff, what about from the moment where we have the emergence of the uptrend? So a lot of technical analysis and institutional models kind of go into the depiction, recognition of this event. What we've talked about the changes in wave character. Anything else specifically, maybe about the character of the speed with which the price moves, or how long the reactions unfold, maybe duration, any characteristics in this area?
Well, the one thing I look for to really tell me that something that the tide is going in or coming up, where you're having that significant change of, I guess, using Wyckoff words, where you're really almost confirmed of the markup phase. It's when resistance becomes support and or support becomes resistance. Notice over here, congestion. There's a market top. Here's a market top. Here's a market top. So all you got to do is put on a horizontal line on the price chart, and you see that for several weeks, several months, who knows, maybe even several years, that this area on the chart provided resistance. Every time we got into that area, we just couldn't move through it, and collapsed and collapsed and collapsed and collapsed. And then all of a sudden, what happens is now what was once resistance is actually acting as support. Okay, and so whenever I begin to see that, say, change of whenever the modality or the role, the function, whenever those roles and functions of support and resistance become reversed, then that really tells me I've got a sea change going on. That really does, and that whole idea, that approach works on 15-minute price charts of whatever you're looking at, British pound or Apple, and it works on longer term price charts. Like, for example, I'm looking at I think right now, because I do the commodity junctures portion at Elliott Wave International, I'm the chief commodity analyst there. There's a situation where I've got just this kind of setup working in the feeder cattle market on a monthly chart, where we basically come back down, and what was once resistance is now acting as support. And it's usually that change that really sets the stage for something quite dynamic to the upside or to the downside, because you can kind of see the same thing beginning to occur over here. You've got your resistance, and then you've got your support for your pullbacks. And then all of a sudden, what happens? We now come below that area. So now you're basically, this is a big air pocket, and now any kind of rally attempt that you experience is going to get caught up. So now, again, what was once support is now acting as resistance. Again, great, just a very simple, and this is like chart reading, Edwards and McGee stuff from the old days, but for something so simple, to be so dynamic and effective time and time and time again. It just astounds me that, so many technicians of today are so enamored with, quantitative analysis that they seem to forget, I think, just the excitement of, tape reading and chart reading that, Charles Dow and Henry Poor, I mean, those guys were, Dow Jones Industrial Average. Hello, Charles Dow. He was actually an individual. Henry Poor of Standard & Poor, S&P 500. These guys were technicians, and it continues to blow me away that, sometimes I wonder, it's like, why isn't technical analysis more popular? Don't people realize that when Wall Street began, that, a lot of your big guys of the day, your notable names that we still mention today, these guys were technicians. They were reading the tape. They were reading the charts, doing exactly the kind of work that you and I are doing today, Roman.
Yeah, absolutely. I mean, Dow himself, was a tape reader. So,
Yes.
yeah, we should recognize this. All right. Um, uh, Jeff, let's quickly talk about the conclusion of the uptrend and characteristics of the distributional phase. What kind of, specific characteristics for the ending? Let's say, to me, it's either something like of the climactic run where we have a lot of excitement, or some kind of deterioration of the upward progress, where either demand is fading or demand is being met with the aggression of the supply, and that stops the price from progressing upward, much faster. So, and that
Mm-hmm.
shows that slow of the momentum. How would you describe, the distributional top?
Okay. The way I would look at it, or the way I view it using, I guess, my language here and a little bit of Elliott is, and I tell my subscribers this, if a market rallies, it means something. If a market fails to rally, it means something. Similarly, if a market declines, it means something. Or if a market fails to decline, it means something. And it's your job as the analyst and trader to listen. We don't listen enough. Or what happens is we do listen, we just don't like what the chart is telling us or the market is telling us. But what you'll notice over here, this is a nice move. A lot of length to it, a lot of duration. This is a nice move, okay? This is a nice move. But notice it's not as nice as what we saw previously, okay? From, say, spring over to this area right here. So what you're beginning to see is you're beginning to see advances in the market, which are just not covering as much ground as, say, what occurred 3 months ago or 6 months ago or 9 months ago. And then you see subsequent rallies again, and it just seems like, man, we're continuing to rally, but no matter how hard we try to rally, we're just not gaining any real additional ground. I mean, yeah, it might be a couple of bucks, or maybe it might be 10 or 20 bucks, depending on what issue or stock you're looking at. But it's just like, man, we're seeing all these rallies that we sometimes interpret, unfortunately, as strength, but we're not gaining any distance. Okay, when you see that kind of price action on a chart, listen, because that is not healthy price action. That is price action. That is a market that's struggling desperately. And if you don't listen to that, you will be punished, because what will happen is finally everybody just kind of gives up the ghost, and boom, you see a big, massive sell-off, and everybody's like, whoa, what happened? What was going on there? I thought everything was fine. No, it wasn't fine. And it hasn't been fine for, 3 weeks to 3 months. And you saw very similar price action to this, Roman, just not to get too historical, back in late 07, between
Yes.
07 prior to the 08 decline.
Right.
It's just like, man, we were trying to climb higher and higher and higher, and it was just very hard for the market. You could look at the chart and see that it was struggling. And then what you began to see was this. You began to see any kind of strength that we did see, it developed clearly correctively. And then boom, So I always tell my students that whatever questions you have about a market, to go long or to go short or where to put a stop, those questions are the chart is giving you the answers. It's just, are you asking the right question, and are you willing to listen to an answer which may or may not be what you want to hear?
Yes, absolutely, and it just, so similar to what we go in our classes. So it's just great to hear it from you, Jeff.
Oh,
Okay,
thank you.
yeah, absolutely. Well, let's move on, and we are at 3:33. Okay, we're actually doing really well on time. So I took a liberty of putting the slides together. This is from your presentations, and want to ask you maybe again a general question. With any
Okay.
of these patterns, price patterns, what kind of characteristics would you be expecting from as maybe like the precursor to a lot of them where they are reversing? What's kind of like the behavioral characteristics there, and what would you be expecting after those patterns?
Okay. Good question. Good question. Okay, let's start with the impulse wave over here. The 5-wave movement, again, 1, 2, 3, 4, 5, this is an impulse wave. This is going to identify the direction of the larger trend. And this is what you would find in the very, say, late stages of an accumulation phase, or more than likely, more so in the early stages of a markup phase. You'll begin to see 5-wave rallies. And then as that markup phase continues, you'll see more 5-wave rallies with intermittent examples of, say, the flat pattern, which is right here. This is the flat right there. Or you'll see a zigzag over here. So again, you'll see that your pauses within the accumulation, or I'm sorry, markup phase, are going to be interrupted by breaks, minor breaks with flats or zigzags. So during that early markup phase to, say, middle markup phase, your advances are going to develop in 5 waves, clearly 5 waves. And then your interruptions to the trend, those little pauses or brief periods that last, say, 3 to 5 days or maybe 3 to 5 weeks, they're going to unfold as your zigzags or your flat. Now, when you get to the later portion of a trend, and this would be, say, very mature markup phase, or as we move into distribution, then that's where you're most likely going to encounter your diagonal. This is a terminating wave pattern, and it can only occur in very specific situations. For example, you can have an ending diagonal in the 5th wave position of an impulse wave, or as wave C of either a flat or a zigzag. Okay, so most likely what you'll begin to see is during the very late stages of a markup period, you'll see an ending diagonal begin to take shape. Or prior to the ending diagonal, you'll see a triangle. Okay, triangles, again, triangles are precursors. Triangles are a precursor of a final event coming. It's like, hey, you see a triangle, watch out, because that triangle is always, no exception. It's all, well, there is one exception, but it's albeit very rare. It has to do with complex corrections. But triangles essentially form prior to the final wave of a sequence. So you can have a triangle in wave 4, and it gives way to the final move, wave 5. You can have a triangle in, say, the wave B position of a zigzag. Again, the final move is wave C. So that triangle finishes up the larger pattern. So like, for example, in your very, say, very mature stages of your markup period, you'll maybe see a triangle form and then one more impulse wave, but that impulse wave will begin to take the shape of the diagonal. And then what happens is these moves to the downside, or they're going to flip. So instead of seeing 5-wave rallies, you're going to see 5-wave declines. And instead of seeing 3-wave declines, you're going to begin to see that change in attitude where your movement, your counter trend movement, rather than seeing three-wave declines, you're now seeing three-wave advances. And that's the key thing. That's the transition. So whenever you see this happen over here, whenever your rallies begin to distinctly take the shape of three-wave moves or Elliott wave corrective structure, that's a big, hello from the market that, hey, you've got to be watching this. You've got to be paying attention because you're moving from that distribution phase to the markdown phase, and things are going to get bloody really quickly.
All right. Okay, well, let me go through the Wyckoff patterns right here. So the impulse wave is obviously an uptrend. And in the uptrend, we're looking for areas where momentum is increasing, slow a decrease of the momentum into some local areas where we also could see shortening of the thrust, reaccumulation areas where maybe into the end of the reaccumulation we're going to have in phase C a spring recovery out of that, sign of strength, backing up action, and then again momentum comes in as buying is always increasing on those waves, and we usually see decrease of the supply with some local spikes on into phase C. Uh, More pronounced, kind of like trading ranges where you might see minor sign of strength in the middle of the range. Usually that's a sign of strength. And then out of that, some kind of finish and top information that could be in the form of the diagonal, where we see a change of behavior first. So this is a very, very aggressive selling on the way down, urgency to sell. But because this pattern might be appearing more in the leadership stocks because it shows a lot of higher highs and higher lows, definition of the uptrend. There is still a lot of enthusiasm to buy in this maybe like momentum popular stock, and that pushes the price to new highs every time. So, and we go into upthrust, and then upthrust after distribution. Usually those patterns are harder to kind of like see, to predict, because the selling goes into the highs. So the value sellers sell into strength. And then it becomes extremely clear when we have a significant leg to the downside that usually first projects into the base of this formation. And that signifies that complete change of behavior. So before it was conditional change, this is more of kind of like result-oriented change. Any type of double bottom, I always look at the character of this leg, comparing it to the character of the capitulation leg. So we should see diminishing bearish characteristics where maybe the downward spread is diminishing, where supply is diminishing as well, and you might see only local increase of the supply into the end of this leg or into a slight sprint situation. And usually those rebound pretty nicely, just because in its previous rally, there is already some hidden accumulation that's going on. So supply is becoming more and more under control. This accumulation pattern is a little bit less common for me personally. So usually when there is a lot of volatility like this rally here and then this decline, it takes some time to produce, a more prolonged accumulation. But I've seen quite a lot of this just on the shorter time frames for some reason, and it just shows you that the higher lows are finding the bids, and those bids are slightly increasing each time. Also, you could see that the volatility generally goes down in this pattern. So, and that's a precursor for bullish behavior and therefore a rally. And then this is a little bit more of the weakness in the reaction. So this creates an oversold condition, which is in that time frame could be a little bit extreme. So out of the oversold condition, there is usually a robust rally up. Okay, well, we're talking about the same things, Jeff. So here's this ending of the uptrend and the downtrend in the diagonal. It's a very interesting process of compression, because when supply comes first, it's so aggressive, it produces that first initial change of behavior. And our inclination is always to think the trading range. But this stock is so strong that it just carries us over to a substantial upthrust, and then again, selling and selling and selling. So these multiple attempts of sellers to present supply into the market, it depresses demand and it weakens demand. And with that, demand cannot produce a better result. So there is this compression, but still in the bullish manner.
Roman,
Yeah,
can I jump in for a moment?
sure, yes.
Okay, notice the extreme of wave one right here, okay? And then notice the distance from the extreme of wave one to the extreme of wave three. Now notice the distance between the extreme of wave three and wave one of the diagonal, and then wave three of the diagonal, and then wave five of the diagonal. So basically what you're watching here is this market is continuing, it's struggling, it simply cannot make, it can't do this. We're not going to see anything that dramatic. So this is just a great indicator whenever you see this on a chart that, hey, the market is struggling, you're coming down.
Jeff, are you asking me a question?
Oh,
Sorry.
no. I just wanted to point that out, that again, the distance between the price extremes when they begin to shrink so noticeably like this on a chart, whether it's a 60-minute or a weekly, it's again a awesome precursor of a very high confident move in the opposing direction.
Yes. Okay. Great. Let's go to the next one. Okay. Well, the pattern here is just of the reaccumulation. So this is a trading range. And what we're seeing here is just an element of strength. And if in the previous ending, diagonal ending, right, we have a reaction that goes into the base of where this rally has started and then breaks to the downside. So there is a failure, and that failure acts as a confirmation. Then here it is slightly different, right? So a much higher low, and then the recovery, quick recovery into the high of the previous rally. And this whole area right here, it just suggests that there is buying behind it, and that's why it just overcomes, multiple highs. Jeff?
Oh no, I totally agree. I will add that the leading diagonal, it's actually a little bit of a rare pattern. But the stair step to the upside, and typically what I like to see whenever this specific structure finalizes, is that I like to see prices fall below the prior swing low, because that's an attractive area for stops, but not below the low of the wave two. So this distance between the extreme of wave four and the extreme of wave two, this is kind of like the sweet spot to pick up a buy side trade in the direction of the primary trend. So yeah, whenever you see something like this, certainly at the end of, say, maybe a very large three-wave move, pay attention. Absolutely.
All right. Let's go to the next slide. Okay, well, a much more complex structure for me here. Reminds me of some of the Apple examples that we go in the classroom. So it seems like, initial change of behavior has more weakness, so continuation. Usually on this leg, on the second leg of the continuation here, we're going to see that selling is less and the downward spread is starting to diminish. That's just the reflection of a temporary selling exhaustion. And this exhaustion brings to kind of like a vibrant rally, which has some demand behind this. So weak hands are coming in and they're buying. And that's what produces more of the increased momentum characteristics. But the key for this is that it can't overcome the previous intermediate high. So there is a failure to overcome it. And this failure is suggestive that we're going to have continuation to the downside. Natural spot to stop here, sometimes with the minor sign of weakness, undercutting the support, and then just no ability to rally, last point of supply, maybe, in the more local formation, and then continuation to the downside. Jeff?
Well, the pattern that we're working with here, this is a double zigzag. There's a formation or a family of corrective structures. The proper name is a complex correction. And we use the notation W, X, and Y. Now, the WXY, even though we call it a complex correction, it's basically a very simple wave pattern, because all it is, it's two corrective wave patterns joined together by an X wave. That's all it is. So this would be a zigzag, and then the subsequent decline would be a zigzag. That's why in this instance here, this is a double zigzag. But you can also have double threes, or what we sometimes refer to as a combination, where wave W might be a zigzag and wave Y might be a triangle or a flat or some other type of corrective structure. Now, the time to look for such a formation has a good gauge of that is what actually transpired during the preceding, in this case, advance. Now, within an impulse wave, waves 1, 2, 3, 4, 5, typically we like to see a 1.618 multiple between wave 3 and wave 1. Well, sometimes if you're looking at a very exuberant market, you might see wave 3 travel to a 2.0 multiple or a 2.618 multiple of its corresponding wave 1. So whenever you have a very large, say, advance or decline, a single corrective structure, albeit, say, a zigzag or a flat or a triangle, sometimes a single corrective structure is not going to be sufficient in actually correcting the preceding move. And so if you have a very large move, that's the time to be looking for a complex correction such as this.
All right. Okay, anything else? Okay, well, the triangles. Well, in the bullish triangle, we're seeing those minor sign of strength. So usually they will happen in the upthrust action, where price temporarily commits up and then almost instantly comes back into the trading range. The higher lows will define the strength, where the demand is coming in much earlier at the higher price, and that's what pushes the lows to the higher level. Then usually breakout is very on the high momentum type of signature. We are not going to have a lot of backing up action here, as even though it shows a lot of strength here, that strength, it materializes into much quicker absorption, and at this level already supply is just in a lot of strong hands, so not a lot of backing up action. And then the reverse for the downside. Jeff?
No, I'm totally in agreement. You got it. That's
Well,
what I would have said.
yeah, okay. Well, okay, let's go to the market update. Okay, great. We're done with this segment and we are at 4 o'clock, so we have, yes, about an hour. Okay, could we start with the Bitcoin? Because I'm sweating out the trade here, Jeff. Okay, so I open a position right here. So why don't we start at a higher time frame? And the reason for this trade, and this is so funny that it's happening live right now. The reason for this trade was kind of like seeing a little bit of the deterioration of selling and buying at the same time, and then we're starting to see some kind of reversal characteristics on a lower time frame right here. So the idea here is that we're having some swings, and if we're catching the reversal, maybe a swing into the 40,000 area, something like this. Not necessarily extremely bullish, but not necessarily extremely bearish either. We're just trying to capture the swing itself. So that's kind of the trade. But Jeff, what about just the count? The wave
Okay,
count?
well, the way I'm looking at the count is I really I was initially. Can you expand it out a little bit, Roman?
Okay, like this.
A little bit more. Okay. What I was thinking like a week or so ago was the spike low down here
Mhm.
was the end of a large ABC decline evident on the daily chart level. Okay, but considering this the subsequent price action we've seen, what you'll notice is what we have here is a three-wave move up, and then since then we've come down. 1, 2, 3, come down, counter trend move, and then a 5. So I think it's probably more appropriate now to go ahead and identify this low as the end of the wave C decline on the
Yeah,
daily
that's good.
chart. So I still like the idea that you've got ABC down and done on the daily chart level. This whole area that we're looking at in Bitcoin, I think, is phenomenal support, bigger picture, longer term. Now, to address subsequent short-term price action, I like that as an impulsive move up. And then I would identify everything over to this low here as a running flat correction. Okay, so I like the idea that this is like one up, running flat correction two. So if I am long Bitcoin, I'm basically long against this low right there.
Mm-hmm.
I do not want to see that level give way. Now, remember, okay, the market, whatever adversely affects the most people tends to be what happens. So if we don't start immediately moving up out of the pocket here, and a lot of people are believing what I believe that, hey, Bitcoin's bullish, they could be long against that swing low or long against this swing low. So what happens is we drop it down briefly, maybe over the weekend, and then boom, off to the races here. But whether from current levels or maybe after running some stops here, I'm still kind of looking for an upside resolution because we've gone up in this market and notice where resistance is, okay? And higher lows here, okay? So we're definitely challenging the prior resistance area as set by the chart. And I really think once you start clearing that 40, 42 handle right here, and you see prices trading up around 45, again, I think that's when you're going to see on the chart, resistance all of a sudden becomes support. And when that begins to occur and is indeed confirmed, then you're off to the races.
Mm-hmm. Yeah. So what I'm hearing from you, Jeff, is that you kind of approach it like myself a little bit here, more with tactics even, not necessarily. I mean, like, yes, we definitely could label a lot of things here. Okay, a very clearly defined selling climax, a very clearly defined automatic rally. That this defines the boundary of the trading range, and then the subsequent secondary test shows the boundaries for phase A. We have an immediate upthrust, let's just call it upthrust for now, in phase B, test. And this is a question. Is this a phase C or is this a secondary test as a minus sign of weakness just because it made this lower low in phase B? So that still needs to be addressed. And so therefore, to me, we are still in the trading range, and the bias at this point it looks like it's trying to reverse and try to attack this 42, 44 level, at least an attempt to do that. But at the same time, if this low will become that minus sign of weakness, we could potentially go down. So whenever we are in this type of situations, I think what Jeff is suggesting, kind of like using tactics, is the most appropriate thing. So what I started doing with Bitcoin is just basically trading. So I had a trade right here. I traded where was it? I think it was somewhere here. Yeah, there was a trade here. It was, yeah, I don't remember exactly how that unfolded. So, and I'm trading it right now. So what am I trying to do? I'm just trying to see if just basically I could capture swings, and if there is a swing to retest 44 or 42, then I might be either considering exiting here or continuing with this trade. So I would say at this point, yeah, tactics probably are much better than analysis itself.
Mhm.
So kind of like go with the flow, so to say, Jeff.
Oh, absolutely. And really, as we've talked, I think privately, Roman, I'm very much of an end user of technical
Right.
analysis. So I do technical analysis in order to identify a high confident trade setup. And I tend to, and depending on what I'm trading in the vehicle, sometimes it's a very short term type trade setup or even a longer term type trade setup. If somebody were to ask me, it's like, hey, Jeff, what's going on in Bitcoin right now? I probably would say, hey, don't have a strong opinion. And the reason why I don't have a strong opinion is quite evident
Hmm.
that you're just as you said, hey, you're in a trading range. And for me as a trader, I'm not that nimble or quick or that good to trade, 5-minute price charts, or I simply just don't have the desire to do that. So I'm I'm not playing here. Okay. I got in. Well, I didn't get in, but I'm just saying, arguably, this is my kind of trade. Market's trending up,
Hmm.
I want to be long. Market's trending down, I want to be short. I want to get in late, I want to get out early. I want to get in late, I want to get out early. This kind of stuff, uh, I'm on the sidelines, and this is where I tend to say that it's important as traders to remember you can be long the market, you can be short the market, or you can be flat the market. Every time I try and trade this kind of crap, I just get beat up. And not only do I get beat up by just small loss after small loss after small loss, what happens is now you're starting to damage your psychology because you're looking for the market to go down and it doesn't go down. So you look for the market to go up, it doesn't go up. Then it comes down again, so you're like, okay, maybe I was wrong, let's go short again. What happens? It goes back up. So now I'm mentally and emotionally exhausted, and I've queued up a good portion of my trading account. So this is where one of those instances where it's just like, hey, stand aside until clarity actually returns to the market. Think about it. Okay, it's 6, 7, 8 o'clock at night. You're driving down the road. You got high beams on. It's a clear night, full moon. You can see clearly. Okay, so you're going to drive 60, 70, 80 miles an hour. Okay, then all of a sudden a rainstorm comes and it's a downpour. That's going to cut visibility down dramatically. Well, do you still drive 60, 70, 80 miles an hour in a downpour? No, you slow down. Okay, you slow down to the extent of the visibility. And at this stage of, say, the price action in Bitcoin, the visibility for me is extremely low. So I'm either like on the side of the road, under a bridge, staying out of the rain, and I'm going to wait. We get back above here, and then resistance becomes support, I'm in. Or if we come down and support becomes resistance, then I'm short. I really don't care if I'm long Bitcoin or short Bitcoin, because as a trader, my job is to make the cash register ring.
Jeff, you're much wiser than me because I've been trading this thing, but only because we have the Discord group now with crypto traders,
Yep.
so it's kind of like almost a requirement now for me to
Well,
do that.
well, let me say this, Roman. I have a friend of mine who's a very active crypto trader, and he taught me much of what I know about the crypto markets to this day. And he's like you, but he is in front of the screen watching 5-minute price charts, and he's actually done quite well trading these short-term
Yeah,
swings
yeah, there is a
because
lot of movement there because it's
oh
so
yeah.
right now. Yeah.
No, he's had a phenomenal week. So,
Yeah,
when the market moves up, boom, he puts on a fairly large, hefty position,
yeah. You
holds it
leverage
for,
that and you oscillate your trades around support
yeah.
and resist, but you have to be skillful with that. Jeff, I'm not as skillful just because I'm not always available. Like my day is so busy, whatever I see, like, okay, I go for it. And then if it works out, it works out. If not, so I'm not really trading, I should be uh, prohibited, from trading it on such a low time frame.
Well,
Um,
if you have the ability and you're swinging a big bat, you can make some phenomenal money
yeah,
doing during this.
yeah,
But
and the
it's very
leverage allows it.
it's very time intensive, and
Yeah,
it's one of those things where I've done that in the past, and I've like gone to the bathroom, stepped away from the computer for like 5 or 10 minutes, come
yeah,
back, and it's just like I'm down $3,000. What happened? I was only gone for 5 minutes, and that can definitely happen in an extremely volatile
yeah,
market like
yeah.
Bitcoin.
I know. Okay, well, let's talk about stock market. So here is
Okay.
S&P, and I wonder what kind of uh, Elliott wave count do you have of the COVID-19 low?
I do not have one.
Interesting. Okay. So,
I simply do not have a strong opinion on the S&P or the Dow. Now I see something in the Russell that I like and that I
okay.
think potentially is offering me a trade setup. Because again, I look at the market really, I'll ask a bunch of little questions, but the real question I'm really most interested in, do I have a trade? And so when I look at like a daily
Mhm.
price chart of the S&P or the Dow Jones, I'm not really seeing anything that's kind of getting me excited. But if you
Okay.
can pull up
Well,
a Russell chart, I'll show
okay.
you what I'm looking at.
Sure, absolutely. But before we go there, let me ask you this question, just to clarify.
Okay.
So, I totally get the position of like I don't have the wave count here. I absolutely understand it because sometimes I come to the same conclusion with like looking at the trading range. I don't understand it. I don't understand the bias. I don't understand the labeling. So this is not mine. I'm going to go somewhere else. So I get that. Um,
Well, let me just interject a thought here,
mhm.
and just say that's okay.
Yeah, absolutely.
Um, and a lot of times, people who are possibly new to Elliott or even your seasoned Elliotticians, they'll look at a price chart and a wave pattern or wave count will not be readily available, so they force it. And that's the worst thing you can do.
Mhm.
Never force a wave count. Either you've got something and it looks textbook and great, you can run with it. But if you're looking at a price chart and you're scratching your head, my advice is leave it alone and go someplace else, because the longer you stare at a blank price chart in search of a wave count, what will always happen is you'll either default to a conscious or a subconscious bias. Okay. And that's very, very dangerous, because now you're labeling the price chart the way you want to see it versus the way it actually is. And sometimes those two ideas are incongruent.
It's so interesting that you talk about this because we encounter the same problem. And sometimes I see how, and maybe this is because of me, guys, and I'm talking about to my students, at Wyckoff Analytics. There is definitely an emphasis on labeling, right? So we want to understand our phase analysis or phase labeling, the Wyckoff event labeling, and so on and so forth. And sometimes we do force that labeling into the specific kind of pattern of accumulation or distribution. And usually that bias has been developed by a very quick, almost like self-talk that we have, like the first impression. There's a lot of like kind of like um, transference from the past of what you've seen, how you traded it, comes into that moment. And you have like this instant call for a specific bias. And then what do? You start labeling everything. My idea right now when I work with students, especially in the practical class, is to develop the next step, which is basically say, okay, well, this could be just some bias that came to me, like very unconsciously. So now I'm going to sit down and I'm going to analyze this whole thing. And then we go through the algorithm as to how we analyze things. And then what that does, it gives us more objectivity to our observations, and then gives us more objectivity. Better observations gives us more objectivity with better deductions about what we're seeing. So we're trying to be, more and more objective through this process. Jeff, let me come back to you with this question.
Okay.
Along the way, since the COVID-19 low, would you
Mhm.
see here any opportunities? Because I understand your style, of analysis is just to only be there and be present when opportunity exists, which I absolutely love. So, what were the opportunities along the way?
Okay. Now, see, this is the question that I think is the more important question. And a lot of Elliotticians sometimes don't understand this. They look at the price chart and go, what's the wave count? The wave count could be anything you want it to be. Okay. But the more important question, the relevant question, the question that really matters to me the most is, do I have a trade? Okay. And even though I'm fully admit, hey, Jeff, do you have a high confidence wave count of the S&P? No, I don't. Okay. But as a trader, I can look at this chart and go crazy with it for several reasons. Number one, the trend is up. Okay, the trend is up. So what does that tell me I need to be doing as a trader? I need to be focusing on buy side trade setups all day long. Okay, here's a buy side trade setup right there. That candlestick is referred to as a piercing pattern. This candlestick pattern right there, that's referred to as a morning star. Right there, you got a bullish engulfing pattern. Those 5 candles right there, that's actually a tower formation. You have another piercing pattern right here. That candle looks like a piercing pattern as well. There, these candles, that represents a 3 inside up reversal pattern. So no, I don't have a good wave count for the S&P, but I can sit here as a trader and go, hey, trends up. How do we know that? Well, it's pretty simple. Prices are moving from the bottom left-hand corner of the price chart to the upper right-hand corner of the price chart. That's a morning star right there, right? That actually marked the low back in March. So, when I take off my analytical hat, or more specifically my Elliottician hat, and simply focus on my trading hat, I can see plenty of opportunity that's easily discernible. Okay. So I don't necessarily need to rely on my Elliott wave skills. I can rely on my candlestick skills or my chart reading skills. So there were easily a half a dozen just simple textbook, beautiful, low risk, high profit, high confident trade setups over the last year that were easily discernible for even the most basic not Elliottician but technical analyst. So again, you have to go back and you have to ask the right question. It kind of like goes back to Sherlock Holmes. If you can ask the right question, that's going to get you closer and closer and closer to the right answer. So to me, what's the wave count? I really don't think it's that important of a question for a trader whose job and priority is to make money. Because if that's the question you're going to ask me, which you just did, Roman, were there any viable trade setups along the way? Absolutely, a half a dozen of them. And they were clear and obvious, and each one of them was a low risk opportunity, all again in the direction of the primary trend. Exciting chart.
Fantastic. Fantastic.
You just had to ask the right question.
Well, I'm glad I did. Okay, well, let's go to Russell. And what is the story here?
Oh, the Russell. Okay, I like this. Okay, and what I see here is I see this price action that we've done recently. Notice the converging trend lines here. So I'm thinking triangle.
Yes.
Okay. If you expand the chart a little bit, I'll point out a few other things that I think are interesting. Okay. The price action we've seen just the last few trading days, like for example, you've got some candles here which are with very long lower shadows. Long lower shadows basically tells us that the market is rejecting lower prices. The sideways price action that we've done recently, I think fits best the Elliott wave contracting triangle pattern. And my algorithm a lot of time, because you said you had an algorithm that you offered your
Mhm.
students on just decision making process, or when analyzing a price chart using
Yes.
Wyckoff. So I pretty much do the same thing. The last, say, what, 3 weeks or 6 weeks in the Russell, does this price action look like an impulse wave? Yes or no? No, it doesn't. Does it look like an ending diagonal? No, it doesn't. It doesn't have the structure. Is this a zigzag? No, it is not a zigzag. Is this a flat? No, again, the pattern, you don't have the proper subways to call it a flat. Is thus, by the process of elimination, I'm basically forced to embrace the idea of a contracting triangle. Moreover, the substructure fits the interpretation. So you've got a triangle here. Here's a piercing pattern that we have it's a candlestick reversal pattern, long lower shadows, and you're starting to now, over the last, say, 5 to 6, 7 trading days, the range of the price bars, the candles, are getting larger and larger. So I will be looking for this to continue higher as we move into June. And if I'm lucky, we might see something to the tune of 23.7, 28. Who knows? Who knows how high? But here, I definitely see a trade. And moreover, I can also see a viable Elliott wave interpretation, certainly of recent price action. So I'm checking off my little my checkbox. I'm going through my
Mhm.
to-do list here and go, yep, that works. Yep, that works. Yep, this works. So I know what's going on here.
Mhm. Jeff, would you feel more confident when you would have both, like the price pattern showing you some kind of setup, and then the Elliott wave count also shows you a setup?
Oh yeah, absolutely. In fact, my approach to markets is kind of like 3 or 4 pronged. Um, I want, I mean, Elliott in many ways is my canvas. I always start there because I'm kind of schooled in Elliott. I've been doing it for 30 years now. But even though the wave principle is a phenomenal tool, you know this as well as I do, Roman, it's not the only tool. The field of technical analysis is rich and diverse, and there's so many different disciplines. A newbie to technical analysis, there's so many roads that they can actually go down. Point and figure analysis, Wyckoff, Elliott, candlesticks, indicators and oscillators, momentum. There's so many different seasonal analysis, cyclical analysis. There's so many ways a student can look at the market. So what I've kind of done over the years is come up with like a 1, 2, 3 punch or a 1, 2, 3, 4 punch that works for me. So what I'd like to see, like I just described here in the Russell, I got a solid Elliott wave interpretation pattern analysis of recent price action. It's a triangle. Boom. The candlestick analysis, which is another skill set I like, because what you do as a candlestick analyst is you're actually analyzing a single price bar. That's a piercing pattern. So those two styles of analysis I really think complement one another, because they're on two totally different extremes. The wave principle allows me to analyze a massive amount of data very quickly. Candlestick analysis is more like a magnifying glass or a microscope. I can actually analyze a single day's worth of price action and walk away with a confident interpretation of who's in control, buyers or sellers, bulls or bears. And then, of course, I want to take a look at my momentum analysis, make sure I see what I want to see using, say, RSI or percent R. And then from there, I kind of keep an idea of, where we are with respect to the not monthly cycle, but as I've mentioned before, I tend to like to see highs and lows occur early on within the month. So we're finishing up May, moving into June. this makes sense. So as we move into June, additional, say, headwind higher for, maybe 2 weeks, could be as long as 4, I don't know. So I definitely like to look at the market using different forms of technical analysis that truly do come at the market from different angles. And then if the consensus of data is in agreement, then at that point, and only that point, do I sit there and say, okay, yes, I do indeed have a high confident trade setup, something that's worth my time and me risking my money on. Otherwise, no, I don't. If I can't count it, I walk away. Or if I don't see what I want to see, or if I can't build a compelling case, then, hey, I walk away.
All right. Well, let me just finish with our Wyckoff analysis here. So climactic run, please note how the support of this climactic run starts with this bar right here as a kind of like the bar of interest where this test goes down. And then all of the subsequent lows are somewhat higher than this low right here. So that in itself suggests reaccumulation. Some buying, early buying, we're seeing still at the 1/2 of the trading range. That is acting as the precursor to the rally that overcomes the resistance in the upthrust type of action. Just a single buying here. And then a more meaningful reaction, which we would be comparing to the last reaction as well. And we're seeing how in the last reaction, result to the downside is diminishing. And with that, what's so different about this is that we have increasing effort to push the result down, and yet the downward result is diminishing. So this is a bullish action. It suggests that demand is present. And then recovery out of that, local spring below this low, test, and yes, we are in the upswing. So I think that the easiest thing here to do is probably what I'm trying to do here with the call here. I'm not really trying to call like, okay, a big bull market from here yet. I want to see a confirmation of how the price is going to leave. But it doesn't mean that I'm not trading this, because I'm seeing the reversal. I'm seeing signs of strength over the previous lows. So a trade would be an appropriate event here. And then as the rally continues, you make a judgment on the character of this rally. What kind of wave structure does it have? What kind of character does it have? Is demand coming in or not? And what was really interesting today on all of the indices is that demand actually started to increase today. So that actually surprised me a little bit, because the 10-year today was actually going up. And I thought that, it might put some pressure into the idea that the market could rally. Okay, well, Jeff, what other market? What about gold? What are your thoughts on gold?
Oh, bottom line, everything that we've seen from here to the low, you can either call it here or here. Doesn't really matter. They both work for me. You both have the same idea. I love the trend lines that you've drawn, because what it does is reinforce an idea that I talk about constantly. It's basically a trend line technique or trend line algorithm that I use that allows me to differentiate between corrective waves and impulse waves. But the key essence of the Kennedy channeling technique is counter trend price action tends to be contained by parallel lines. So if you see a price move like what you see in front of us, slow, choppy, big swings up, big swings down, you're not going anywhere, and you can put the whole mess within parallel lines just as you did here, well, that is a key characteristic. All of those are key characteristics of counter trend price action. So I see the entire move down in gold as a counter trend move, and as such will be more than fully retraced once complete. And I do believe it's complete. Now, from an Elliott wave perspective, there are several different ways we could go. Say off the high, A, triangle B, C. 3 up for A, 3 down for B, call that an X wave. So A, triangle B, C, X wave, and then maybe another A, B, C into the low. So that way we got 1, 2, up, 1, 2, and then maybe another 1, 2, 1, 2, or depending on where you want to call the low, 1, 2, 1, 2, or 1, 2, 1, 2, 1, 2. I would like to actually see a pullback, but I think the only reason I would question myself on why I would want to see a pullback is because I really would like to hit gold again between 1860 and 1840. I think that's the sweet spot. But bottom line, I'll be looking for this advance to simply continue higher. We've taken out some, okay, here was resistance, resistance here. Now it's acting as support. Now we need to see that change of, say, function roughly right about here. We're getting close. Say between 1920 and 1960, we'll tighten that up, say 1940 to 1960. So if we can punch through there, those areas on the chart which stalled before, if we can get through there, I think it's easy sailing all the way up to 21 or 22.
Oh my gosh, Jeff, you literally took the words out of my mouth. Everything that you've said. I mean, like literally, this is the analysis that I do every day for gold.
Well, a rose by any other name, as Shakespeare would say, is still a rose.
Yeah. Okay. Well, unbelievable. Okay, so I'm not going to repeat all of this. I'm just going to add maybe some other observations, that I see maybe in volume signature. So we've talked about, those significant bars where momentum is breaking us out of a specific formation. So one of the things that we said, into the resistance right here, we said that all of the tests are extremely good tests. They are in the upper part of those bars. So that shows strength. Even the test where we start approaching and breaking the resistance is also, really good test. And we're seeing how demand is actually coming in this area. So it's not just demand, but supply is also increasing. But what's nice about this is that the test is not deep into the significant bar. So that suggests strength and continuation. With that continuation, that was the suggestion that we're going to have a breakout. And, the whole texture, again, changes, right? So I've been showing you guys that the texture of this rally is of lower demand and then of higher demand. And you could see how momentum is starting to increase in this second area. But at the same time, as we said, that our target zone is going to be 1900 to 1950, 1960. Somewhere here, we should start seeing deterioration of the momentum and deterioration of demand. So could we see this? Well, look at the spread, the true range, and then the next breakout. What do you see? We definitely see into two or three things here. The spread itself is diminishing, and also the breakout characteristics are diminishing as well. So not as much progress above. So from that, we are seeing some diminishing demand character. Could we confirm this with the volume signature? Yes, for sure. So we're kind of seeing how demand is diminishing overall, and that produces that diminished momentum character. But it should be so, because they were aggressively buying in this area right here, and then they stopped. So where would we have a change of behavior? And I forgot, Jeff, what you've called it, the change of, not the regime, the change of
just a change of function, pretty
change of
much.
function. Yeah. So basically the same concept, change of functions, change of behavior. So we need to have some kind of reaction where, because demand is so exhausted at this point, supply would come in and will have an ability to move it down. That would shake out some of the momentum traders. They will create that liquidity event for more meaningful, stronger hands. Strong hands will come in and support the price. And we might go into some kind of pattern after that, into some kind of trading range or short-term consolidation. Okay, well, Jeff, I'm getting such a good idea about how you're trading. So this is really great. Okay.
It all comes back down to that one very important question. Do you have a trade? Is what you're seeing on the price chart, is it worth your time and consideration? Uh, I guess, so again, not to get too far off topic, I teach this to my subscribers, and I ask them, just kind of playing around. It's just like, okay, how many good friends do you have? And somebody might say, one, two, or three, but you don't have somebody say, oh, I've got 30 really good friends. And the reason why is we tend to be very discerning on who we allow and invite into our homes and into our lives. Who do we embrace? We're very discerning. So, for example, I've got, two or three, say, best friends. I could pretty much call them up for anything and they'd be there. I don't have 30. And the reason why, again, is because I tend to be somewhat discerning. But that's a common trait with people. But it's common when it comes to people. I look at a trade pretty much the same thing. I'm very discerning when it comes to my trades. I'm very picky, just like I am with my friends. And I want to make sure that if I pick a trade, that it's worth my time. It's worth my consideration. Just like if Jack comes over to the house, is Jack one of those people who's worth my time, worth my friendship? You know what I mean? And so it's change your mindset a little bit, and you'll be surprised at your P&L in 3 months or 6 months. You really will.
Jeffrey, so coming back to oil, is there a setup worth your time here?
I think so. Again, I view this. We saw such a nice run to the upside here, and then we all we did was really pause. And a small pause is worthwhile. I mean, you're going to have that because if I run a mile, I might need maybe 3 to 5 minutes to rest after that. But if I run 5 miles, I need 20 minutes and a couple of energy drinks. So the recent consolidation really has been nothing more than a reaction to what preceded that. Now, this candle right there that you see, that's a bullish engulfing pattern. I like that. The subsequent day, you have a very large real body. So you could probably say these 4 candles actually represent a bullish tower formation. Then you have these 3 candles here with very large lower bodies, lower shadows. And then you begin to see the real bodies begin to widen, meaning the real bodies are getting larger. And we're starting to get above this area that's been resistance and holding the market down. So I like the upside. And, is this a daily chart? 2-hour
Yes.
chart?
Yeah, it's a daily chart.
Daily chart. I wouldn't have problem buying crude at the market against yesterday's low, because I really wouldn't want to see yesterday's low give
Yeah,
way.
I agree with you. Yeah, it looks pretty bullish at this point. So we've talked about, this bar that defined this whole action right here, climactic run, change of behavior, suggesting a trading range. Then multiple attempts to continue that fail, suggesting a rally. And then we said that this rally looks like a phase B type of rally, where you have reactions that are deep reactions. And usually after phase B, what's going to come? Phase C, in the way of a reaction, some kind of like this type of the reaction. Well, here it is. It just shows that it's somewhat stronger. It only goes to one half of the trading range height, and then reverses here in these 2 bars. The question here is, well, what if demand is diminishing? Well, no, I'm not going to say that demand is pushing the price, without an increase. These 2 bars are just a reaction. It's just a very bullish reaction. And then after that, demand is starting to decrease. But we know that whenever supply has been observed, demand, small demand or diminishing demand could push the price higher. So, and that's what's going on. So this shows a lot of strength. So I think that we're going to accelerate right here, possibly, at least for the short term, maybe like into 70, some kind of acceleration. And that could be a really good point of entry, as this strength will not allow the price to retrace deeply back. So we'll have to see how that's going to happen. All right, Jeff, we are at 436. What else? What else should we look at for the market?
Let me see. I got a couple of stocks that
Okay.
I kind of just wrote down that I thought were interesting. And probably the best way to start this would be, hey, these are charts that I'm looking at, and these are charts that I'm excited about.
Okay.
I don't have any positions in any of these, and also too, I got to throw out my typical disclaimer. If you trade, you can and will lose money, and if you don't know what you're doing, you can lose a lot of money very quickly. So don't misinterpret, what I'm about to say as specific trading advice, because I don't do that sort of thing. So there's my disclaimer. Let's look at some charts. Pull up a chart of Zoom, daily Zoom, ticker symbol ZM. And you can put it to, say, a weekly time frame. Now, what's kind of interesting about this chart is, let me see, can you compress that data anymore? There you go. Take it off log scale, go to linear. There you go. Okay, so going back to, say, April of, what was that, 2020 or 2019, I'm looking at this move up as like wave one, big wave one up, big wave two down into, say, December, January 2020, wave three top. And just so you know, right here, this is a dark cloud cover, very significant bearish reversal pattern. And then subsequent price action, you pretty much have a three-wave move down. The slope of the movement to the downside is what I would consider to be corrective. And notice we come right back into a small support zone. I'm interested in this. I'm curious to see what will happen moving forward, because I like this as pretty much wave one, wave two, wave three, so wave three, so wave four. And if that's the case, then this could really be an awesome opportunity moving forward. Now, I could be totally wrong on this. In fact, let's just go ahead and say, hey, I am wrong. But earnings for this issue come out next week. And I'm just going to be real curious to see what happens here. But as far as the overall, just simple structure, simple chart, this has got the picture that I like to look for.
Okay, well, let me give my interpretation. I'm going to come back to the daily here. So very good rally. We're seeing how the stop in action, with this climactic volume signature, which represents increase of the supply, stops the whole advance. And then we are going into a trading range. Some weakness, especially in this area right here. So this is where demand is just diminishing. So that doesn't produce really good rallies, and under its weight, it just collapses. Local stop in action, and then we go into a trading range. So I think that my idea here would be kind of like a swing trade that could potentially become a long-term trade, because we do have a nice causality right here. So I would be thinking about this as a minor sign of strength. And then if the price starts to move like this would be my point of entry. And I would be thinking different targets, and would be thinking about scaling out, throughout this area, especially closer to this resistance right here. And then leaving some to understand what's going to happen here. Would we overcome it? in a more major sign type of strength? Would we back up and successfully stay above? If we do, then continuation ability to add again. But definitely, a short-term bullish look that, tries to resolve itself. Okay, Jeff, what else?
Cool. Let's take a look at Ambarella, ticker symbol AMBA.
AMBA. I'm sorry.
Adam, Mary,
yes.
Bongo. There you go.
Okay, great.
Again, this is one of those charts that has my picture. Going back to the March low, 1 up, 2 down, 3. Again, notice the slope of the decline. ABCX, ABC, whatever you want to call it, don't care. I think the trade's to the upside. And again, this is what I look for. This is it's almost elementary in so many ways. And people are kind of surprised whenever I, really, how do you spot trades? What exactly do you do? They think I'm utilizing some type of, complex computer or software algorithm. It's like, no, I know what a good trade setup looks like on a price chart. So what I do is I look for those pictures. There's about, say, a half a dozen, quote unquote, good trade setups. I know what they visually look like. So all I do is comb through charts looking for the same picture. And the reason why is, and many of you know this as well as I do, if you get, say, 10 very, 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 very successful people together in a room having dinner, many of them, I would say good 80, 90% of them, are going to have the same characteristics. They're going to have the same, say, work ethic, work attitude. They might be in similar businesses. They may have the same hobbies. They all may get up at like 4 o'clock in the morning and hit the ground running. They're going to not be that different. Similarly, if you get, 10 people together who may not be as affluent or maybe challenged with whatever is going on in the world, those individuals are also going to share similar characteristics. Why am I saying this? Winning trades that work out versus the ones that don't work out. If you go back and look at, let's say, the last half dozen winning trades that you pulled off or executed, you'll find a very heavy list of similarities or characteristics. Those winning trades are going to share several of the same characteristics. Losing trades are also going to share several of the same characteristics. Like, for example, if I go back and say, look at my last, say, 6 losing trades, I can probably bet you right now 4 or 5 of them. Why were they losing trades? Because I picked a bottom. I tried to pick a bottom. I tried to get in before I had confirming price action that a tradable low had indeed formed. So there you go. So once I understand what a good trade looks like on a price chart, all I do is look for that picture. And this is my picture.
Fantastic. Okay. Let me quickly go through this and then we'll go to the next one. So it's kind of weirdly that I'm looking at this formation like this. So there are definitely, 3 attempts to stop the trend from going further up. Majority of the supply comes at the climactic action, and then demand is just diminishing together with supply. So exhaustion into this last rally, that's what produces the decline. And then from here, we're just looking at the spring and kind of like the recovery, still early on the recovery path. So really great place, also look at the diminished volatility just in the spread. Look at the supply here, so low. Relative strength are starting to improve. Yeah, really interesting trade. Okay.
Okay, Roman, let me switch things up here. I'm going to pull up a chart, or you can pull up a chart. Ticker symbol is TTD, the trade desk. And I won't tell you what I'm thinking, and you can tell me what you're thinking.
Sure. You want me to go first?
Yeah, go ahead.
Okay. Well, now I'm thinking in terms of the structure of the waves here. Well, definitely a lot of supply after this point, right? So we have supply that starts moving the price, rallies that are being done in the upthrust type of action with a lot of supply again coming in, more supply, still rallies that do not have demand, and then we have kind of like a concluding terminal volume signature possibly. I like how the price recovers from here. It just covers this whole body. It tries to cover the gap right now. So, Jeff, I probably would not be necessarily kind of like um, trading it here in full force, but I would be thinking that after such a amazing uptrend, maybe we have like a reaction right here, and I would trade this tactically. So anything above this level, I would be buying and we're just seeing what kind of reaction. But at the first attempt to fail, I probably would be somewhere out. So that would be my strategy.
I I like it, and it's pretty much what I'm thinking too. Can you move to a linear scale chart? Okay, awesome, perfect. Again, I go through my little metric here. From the high that we saw here to the recent swing low, going back to that slide that I kind of made a big deal about that I called the money shot, that showed all the 5 different core Elliott wave patterns. So from high to low, does this look like an impulse wave? Does this look like an ending diagonal? Does this look like a zigzag, a flat, or a triangle? Well, it's certainly not an impulse wave, which is probably the more important question, because pretty much all our other choices are going to be counter trend in nature. So what we could simply do is simply identify this as A, and then A, B, C, D, E for a triangle, and then wave C to the downside. And you're a little bit below support over here. What's interesting is if we park that area here, what was once resistance becoming support and vice versa, I like where the sell-off actually stopped. Now, I don't think that there's enough evidence on the chart yet to be crazy bullish TTD, but I do see this as a counter trend move and a corrective decline. And if we can get back above the gap, more importantly, begin to see price highs above where the gap began. In other words, we totally erase that event. Then I'm going to be very curious to see how the declines in TTD unfold moving forward. Because if I see a little 3-wave decline unfold, I'm all over that. But again, this is an exciting picture, but it's a little bit immature. It's kind of like going to the grocery store and picking up a green banana. It's not yet, doesn't have that right color, but in a couple of days it will. That's what I'm looking at here.
Interesting. Yes. Okay. Jeff, let's see if we're going to have any questions at this point. So, guys, definitely, if you have a question on anything, any part of the material that we went through, so let us know and we'll address in the next 10 minutes. Meanwhile, there is a request a little bit here. Alibaba from Mike. What do you think, Jeff? Anything? Yeah, any trade setups that you see here?
In which issue?
Alibaba.
Oh, Alibaba. Okay, can you expand the chart? Oh, yeah, make it, spread it out versus compress it. Okay, the movement to the downside in many ways from the high here is very similar to, say, the trade desk. The whole overall slope movement to the downside, it's nothing I would really get excited about as far as saying, okay, hey, the trend is clearly down. We're working 5-wave declines and we're and those are followed by clearly discernible three-wave counter trend moves. This is pretty much ugly, choppy, sloppy price action. So I'm inclined to say this whole move down from here back in late October, early November, it seems to be counter trend in nature. So, and that would be in the context of most likely the weekly price chart. So let's fast forward to what's going on right now. Do I see a trading opportunity now? No, I don't. What would it take for me to see a trading opportunity? Well, I'm kind of a little bit buy side oriented here because I'm viewing this to be in the late stages or mature stages of a counter trend move. I really would want to see the market get almost, we would need to get as high as say 225 or 230 on a preferably say daily or weekly closing basis. And I want to see something that pops, that's convincing. Like for example, if we could get, you know, two white candles back to back that look something like those two red candles that we see here. I mean, that was commitment. I mean, that incorporated an acceleration gap to the downside. You had no question. When you saw this, it was just like, dude, Alibaba's going down. There's no question. I'd like to see something this convincing to the upside. And if I did, then I'd be like, okay, where do we get in? That's what I would be thinking.
Okay. Well, I think that the rally is possible here. Obviously not the strongest pattern, considering that, you know, in the last couple of weeks, we're seeing the market actually trying to rally. So I would be maybe like very cautious here. The relative strength is in the downtrend, so you only trade in here from just based on the structure that we're at the support, that we had some kind of stop in action, maybe diminishing supply as a test. So usually this type of structural trades, I would wait for some kind of confirmation, a bar like this that, you know, intrudes into the trading range, back reversal bars, or however you want to call them, and then also just some reversal of the intermediate trend would be also very helpful, and just go from there. But ultimately, you know, improvement in the relative strength, that's what's going to give some legs to this trade. Jeff?
Roman, let me just add one more thing. If I were to look at this chart and just have an immediate knee-jerk reaction, that immediate knee-jerk reaction would be, hey, I want to sell this. Like, you know,
Yeah,
for I mean, yeah, exactly, because it's very weak. We're trying to rally. We're not rallying. You know, you've got chart resistance right here. Okay, I'm not attracted to that trade because of the maturity of the entire decline. I think you're probably getting in like, you know, 90% of the correction is already behind us. So the big money, because again, I want to find a trending market move and, you know, buy the pullbacks in that trend. I'm looking for something bigger. And as far as that bigger move, there's nothing to say that that is occurring or that's in place. So I'm either short-term bearish to neutral on this one.
Mm-hmm. Yeah. Okay. Okay. So I don't see any questions except for the request. So let's do one more. Computer hardware, desktop, and again, you know, this is kind of like a very nice swing type of setup where you could see how a lot of selling momentum to the downside starts to diminish into the support, then becomes even less so. Look at the supply signature right here. First reactions to the upside suggest change of behavior. We are in the trading range formation. And I would say that this is an attractive spot. Again, I would just be kind of like trading it tactically. I want to see a breakout like this. To me, that would suggest that we might have a rally into this area right here, into this zone, and maybe just stop here, come back, consolidate more, continue to the upside, something like this. So to me, I would be looking for a swing opportunity. Um, and again, with some signs confirmation, some signs of the supply coming in here, and then a long-term position probably is slightly below, slightly above that. But if this works out really nicely and we overcome this resistance, then I would be more prone to hold on to this position because it shows a lot of strength. Jeff?
Okay, let me take a crack at this puppy. Usually stuff like this I tend to avoid because it's more of a, say, bottom picky. But I guess that's my fault or my bad because sometimes I'm kind of a trading snob in some ways. But I do think this chart has promise and it's worth commentary because you have an initial move down, quite decisive, counter trend move. And then you could, I'd have to check some levels here, but maybe 1, 2, 3, 4, 5. One of the key characteristics of a zigzag, a 5-3-5 pattern, is that the slope of wave C is going to be less aggressive than what occurred in wave A. Now, a great example of exactly what I'm referring to is evident, I think, in the weekly price chart of the 30-year bond going back about 2 or 3 years. The textbook quality zigzag, 5-3-5 formation, sharp, decisive wave A, kind of a lingering, meandering 5-wave decline for wave C, and then you had that big pop up in the 30-year. So I can buy it, A, B, C to the downside. Now, what is this 1, 2, 3, 4? Don't know, don't care. I'm looking at this as A, B, C. Okay, can you expand the chart a little bit, Roman? Expand. There you go. Okay, a few things out there. Okay, now this is interesting here. Okay, you got a bullish engulfing pattern right here. This looks like a piercing pattern yesterday. You could say that maybe that's a left shoulder, head, and a right shoulder right here. I like the kind of double bottom sort of price action. Today's price action was also encouraging because of yesterday's piercing pattern to the upside. So I think from a trade, and this would be kind of like a purely speculative trade that, you know, could turn into one of those, as Roman would say, maybe something to hold on to, because it is an attractive price, would be to buy the market, you know, small position, with a stop at yesterday's low. Because if I'm right, the market's going to prove me right by the market moving up Friday and Monday and Tuesday of next week. Okay. If we come back down, then hey, it wasn't that big of a loss. But considering what I'm looking to make to the upside, we're talking about like a 1 to 5, 1 to 10 risk reward ratio trade, because you're not going to really come into any headwind until you get back into the 20s here, where you've got that resistance area. So I see this potentially, making me kind of go, let's take a look at this. Maybe tomorrow, let's take a look at this. Let's go down to the 60-minute bar chart and kind of break it down, see what we're looking at there. But this is attractive from a risk reward perspective, considering the last, say, 3 days worth of price action.
All right. Okay. All right. Well, Jeff, let me see what other questions do we have. Do we have time for one more?
Of course.
Okay. Let's look at silver. Let's look at weekly. Okay. So I'm gonna do my poor interpretation of Elliott wave count. Number one. Ooh. And I'm lost here. Because I was thinking, okay, okay, like this, okay. I don't know if this is anything complex, or maybe, well, yeah, so this is, maybe it's like this. Okay, so 2, I correct? No? Jeff, what do you think?
Well, okay. The first place to start would be when it comes to counting Elliott waves, I don't like to use candlestick charts. I like to utilize an open, high, low, close price chart. So that would be the first recommendation, because what happens when you look at a candlestick chart and you're counting waves is that your eyes begin to adjust to the real bodies, and you begin to lose the upper and lower, you begin to ignore the upper and lower shadows. Okay, give me some more data to work with. That's one thing that I like about the wave principle. It really does a good job. And there you go, perfect. It gives me a really good job as far as I can quickly and easily interpret metadata in a lot of ways. Okay, now this is an interesting chart because you were going the right way. So it's a thumbs up. The only critique is try and use open, high, low, close price charts. So we'll call that wave one. No problem there. Okay, now this decline, I would probably break it down as like an A triangle BC, some type of corrective structure into the low. Now here's the giveaway right there. We go up, we make a new high beyond the prior extreme, and then we come down. Okay, again, let's go back to our decision tree or our logic tree. What Elliott wave pattern incorporates a test of the prior extreme? It's not a zigzag, it's not a diagonal, it's not an impulse wave. It could be a triangle, but the pattern I'm thinking of is a flat, specifically a running flat, because if you connect these two extremes here, it looks like you have 3 down for wave A, either here or here, 3 up in wave B. Actually, let's do that. We'll call this A, B, C for A, W, X, Y for B, ending diagonal right here for wave C of 2 or C of B or whatever. Either way, you're looking up here and using this is going to be your critical support level of 22. So you were on the right track, Roman, in that you didn't take something which was clearly counter trend and count it in a way that supported or reinforced a bias, like 1, 2, 1, 2, 1, 2, 1, 2, that sort of thing.
Okay, sounds great. And that's a lot of fun. Okay, so we're seeing a really aggressive rally, a really aggressive demand coming in. We've talked so much about, this pattern, different analogs. My expectation was that we're going to stop here at 1/2 of the trading range, maybe consolidate here even a little bit more, or just go through. Doesn't really matter. The pattern is very bullish, and at this point, it is suggestive that it's going to work through the resistance and some supply that we've had here. So we need to see as the price approaches supply to increase, but on a lesser volume signature. And that would be confirmatory of the absorption of the supply at this particular level, at high level. Please note how it also comes at buying climax, up thrust. So this is going to be a very significant point for us to observe. But yes, long-term, I'm bullish on silver. I think that a really good rally is ahead of us in silver and gold as well. So definitely would love to play this. Okay.
Cool.
Well, with this, Jeff, I think that's it for our sessions. So I was just commenting to Jeff today that we just went through this so fast. And hopefully, guys, this third session kind of connects the dots for a lot of you with the question, how do we combine it together? So we were trying to look today at, a look from the theoretical point of view and also, more practical where we're discussing where the markets are. I think the discussion about the setup, the trade setup, or the importance of that over the, let's say, the analysis itself or some kind of labeling or counts, is very, very valuable. I also, again, coming away a lot with the understanding of the character of the swing, the price structure, that could give you an indication, what trend we are in, what kind of bias we are in. So I think it's a very, very valuable tool for us, Wyckoffans, to comprehend and start using a little bit more. And Jeff, it just was a pleasure to go through this material with you, to go through your trades and my trades and listen to your opinion. And then also to this third session, I really liked, where there was so much discussion about the character of the specific pattern. So thank you so much. And thank you guys for being here. If you have any questions, any feedback, let us know. Email us at wyckofassociates@gmail.com. I'll make sure that I'll forward this to Jeff as well. Jeff, what a great special. Thank you.
And Roman, just before we sign off, I just want to express again my appreciation for the invitation to participate in the event. I love this stuff. I love teaching. I love trading. I love technical analysis. And again, very appreciative of the opportunity. And also, I would like to express my gratitude for all the attendees. Thank you for joining us, and I hope you learned something, or at the very least, I hope you were entertained. And
Yeah,
I look
sure.
forward to the next event.
Absolutely, for sure. I've definitely been entertained a lot, Jeff. I really enjoyed all of the sessions, so thank you so much. All right, guys. Well, with that, thank you, and until the next class. Thank you, guys. Thank you, Jeff. Bye bye.